All right, hello everyone. This is Carter, and this is going to be the second sophomore review session on valuation. So I'll just go ahead and get right into it. So first of all, what is valuation and why does it matter? So valuation is really the process, put simply, of just trying to figure out how much something is worth. And I'm sure we all do this internally, just when we're going through our everyday lives. When we go to a food truck and we see a burger that is priced at $20, in our head we're thinking, okay, is this burger really worth $20? Couldn't I go somewhere else and get that burger for $10? Is the quality of the burger so much better that I'd be willing to pay that much? In our heads, when we're buying things in our everyday life, we're always kind of doing these calculations of like, is this thing worth so much that I should be willing to pay this price for it? And that's kind of a key part of this lecture today, is that price does not equal value. A lot of times, there are opportunities where the price of something does not equal the value of it. So for instance, if the price of something is 20, but the value of it, in our opinion, is 40, it might be a good idea for us to go buy that thing. And there's also situations where it's the opposite, where things are overpriced. For instance, something might be worth $20, but it's being priced at $40. So in the world of investing, because price does not always equal value, these are really the situations that investors are trying to exploit, right? Investors are trying to pay less than something is worth, and then hoping that other people appreciate how much that very thing is worth, and then they can sell that item for more than they had originally paid for it. So valuation is really relevant for investors. So hedge funds, private equity firms, lenders who are giving capital to some sort of borrower, and also companies, because companies are also investing in projects or maybe even buying other companies. And then, of course, it's also relevant when a company is selling themselves, right? If you're a company, let's say me and my dad have a company and we think it's worth $100 million and someone else is offering us $50 million, we wouldn't want to accept that offer. So we really want to have an idea of like how much our company is worth, right? So it's really relevant because companies don't want to sell themselves for less than they're actually worth. So as investment bankers, right, they are the ones that are advising these entities on these sort of transactions. So if you're going to be an investment banker, it's very important to be able to assist with the valuing of businesses or financial securities. So really the concept that is fundamental to understanding valuation is the time value of money. So let's look at this exercise. So let's say I am offering you an investment in a financial security that will pay you $10 5 years from now. So I own the security right now, and I am offering to sell it to you for $10. So would you be willing to pay $10 right now for the right to a $10 cash flow 5 years from now? So if you think about it in your head, you're going to pay $10 right now, and this asset will spit out $10 5 years from now. Of course, any rational person would not be willing to pay me $10 for this asset because you're going to be getting a 0% rate of return over 5 years. And you could probably go and put your money in another asset that is of equal risk and get more of a return, right? Because if you think about it, the risk-free asset, or the asset that we deem to be risk-free, is the US government bond. So these are assets that have no risk attached to them. But we still get a 4% rate of return every year when we own a US government bond. That is kind of the benchmark for return when it comes to risk, right? If something that is risk-free, like a US government bond, is giving us a 4% rate of return, we would not be willing to really invest in anything where we won't be getting a 4% return because we're just not being compensated for the risk that we're incurring, right? If I'm investing in something that is riskier than a US government bond, and they're not giving me a 4% rate of return, I might as well just go invest it in the US government bond at that point. So this is kind of what we call the opportunity cost. So it's always important to consider the opportunity cost when you're investing. So in this case, let's say that hypothetically, this asset is just as risky as a US government bond. So I don't really care which one I'm investing in because they're of equal risk, as long as I'm getting at least that 4% rate of return. If they're of equal risk, I'm just going to go to the one that's giving me more of a return. So in this case, we can kind of solve for X here. We would only be willing to pay so much for this asset if we're still going to get a 4% rate of return. So in this case, X compounding at a 4% rate of return for 5 years equals $10. It's just a simple interest formula, right? So we can kind of rearrange this formula to say that X equals 10 divided by 1.04 to the 5th power. and that would be 8.21. So if I paid $8.21, that would mean that I would be getting a 4% rate of return. Obviously, in an ideal world, I'd be paying less than $8.21 because then I would be getting more than a 4% rate of return. But as long as I can pay $8.21, I would be willing to buy this asset. If I had to pay above that, I would rather just go put it in the US government bonds at that point. So I'd be willing to pay up to $8.21. But the thing is that not all assets are as risky as a U.S. government bond. Basically, every asset is more risky because the U.S. government bond is what we deem to be the risk-free rate. So really, every asset we should be wanting more than a 4% rate of return. For instance, Ukrainian bonds. Ukraine is a much riskier country than the United States. They offer a 15% rate of return. So if this asset, the one that I presented to you earlier, that's going to spit out $10 5 years from now, is as risky as the Ukrainian bond, you would only be willing to pay so much that you'll still be getting a 15% rate of return. So in this case, the asset would be worth 10 divided by 1.15 to the fifth power, or a bit less than $5. You can see, because the riskiness of this asset is a lot more, we're not going to be willing to pay as much for the asset because we're going to need to be compensated more for the risk that we're incurring. So as I said, price does not equal value. So sometimes you'll be able to get offered a price that is different than what you think the thing is worth, right? Value is inherently subjective, right? We try our best as investors to come to a discernible number for what the value of something is. But of course, the assumptions such as the discount rate here, which is what we put in the denominator, the required rate of return that we need for something to be worth our while, that is subjective in a lot of circumstances, in a lot of cases. So let's say the price of this asset is $4 right now. Would I be willing to buy it? Yes, I would, because I'm buying it for less than it's worth. But if they were offering me $6 right now, I would not be willing to buy this asset because the price is more than the thing is actually worth. So at its core, valuing assets comes down to discounting the cash flows that the asset will give you back the present value to determine what you are willing to pay for the assets right now. So it's a bit hard because when I'm looking at this asset, the cash flows it's going to give me are in the future, but I'm having to pay a certain amount right now. So the process that we do to figure out what I'm willing to pay right now is what we call a discounted cash flow analysis, right? Or what I'll talk about later is discounted cash flow valuation. You're basically figuring out all the future cash flows that you'll get from investing in a certain asset, and then you're discounting them all back to present value. So we need to make sure that the rate of return we're getting, which I'm not going to explain completely what IRR means. It means internal rate of return, but it's a bit more complicated than that. But when you think of IRR, just think of that as like the rate of return that you're getting from investing in this asset. So you need the rate of return that you're getting to be higher than the discount rate. The discount rate is what we're plugging in here, right? When we're figuring out what our required rate of return is based off of the amount of risk that we're incurring. So discount rate is the required rate of return for the risk that we're incurring. Whereas the IRR, internal rate of return, is the actual return that we're getting. So of course, we always want our IRR to be above our discount rate, because otherwise, why would we be investing in that asset? We would just go to the next best alternative that would be giving us the required rate of return. For instance, with this asset, if we were able to pay less than $8.21, our IRR would be above 4%. But if we paid more than $8.21, our IRR would be less than 4%. So it wouldn't make sense for me to invest in this asset. So as long as we're buying assets for less than they're worth, this will happen. We'll get an IRR above our discount rate. And that brings us to the concept of like net present value, which is kind of just applying all of these concepts. Net present value is just the present value of all of the cash inflows and outflows that you're receiving from a certain investment. And we only want to invest when the net present value is positive, or else it isn't worth investing because there's a better opportunity out there. Back to that concept of opportunity cost. So for instance, if you think about this investment, if the cash flow is discounted to us, if the future cash flow is discounted back to present value are $8.21, and I'm paying $8 for it right now, well, let's say the price of it is $8. Well, in that case, we're losing $8 in the present, but we're getting a present value of future cash flows of $8.21. So $8.21, the cash inflows minus the cash outflows of $8, that is 21 cents, which is positive net present value. Where if we paid $8.25 for this, then we're losing $8.25 right now. That's the cash outflows, but we're only gaining a present value of $8.21. So that's going to be negative 4 cents of net present value, NPV. And it would not be worth our while to do this in this case, right? We would rather just go put our money in the opportunity cost, which is, the U.S. government bond. So that is kind of the core principles when it comes to valuing assets. So now I'm going to get into the two main forms of valuation. So let's say that we have a house that currently has a listing price of $750,000. How can we figure out if that is a good deal? What are some ways we could go about valuing the house? Well, there's pretty much two ways that we could do it. The first way would just be the more obvious way when it comes to looking at houses. You'd probably go look at similar houses that were built around a similar time, houses that have similar materials, they're in a similar location. Maybe they both have a pool or they both have a big backyard. You would want to look at similar houses in your location and then see what they're trading at, right? What the price of those houses is to see if this 750,000 figure is a fair value. Or you could do what we were doing earlier, where you were discounting the cash flows back to present value. In that case, you would be discounting all of the future rent payments that you could hypothetically be getting if you were to lease this house out. And you could discount all of those rent payments back to present value to be able to get the present value of that, which would be like the value of this house to you, right? And you could compare that to that $750,000. So really, there's two different ways, right? We could look at other houses that were built around the same time, just similar houses, right? And let's say that the house I'm looking at is 4,000 square feet. And there are three similar houses in my area. One is 3,000 square feet and sells for 600,000. One is 5,000 square feet and sells for 1.2 million. And one has 2,000 square feet and sells for 500,000. What would I estimate the value of my house to be? So in this case, we can look at the multiple of square feet that these other houses trade at because they're all similar to mine. So for instance, there's one that is 600K, right? And it is 3K square feet. So that would be a 200x price to square feet. I'll just do square feet multiple, right? And then there's another one that is 1.2. Sorry, this should be 1.2 mil divided by 5K. That would be, if I'm doing the math correctly, 240 times price to square feet multiple. And then the last one would be 500K, the price of it, over the square feet. So that would be a 250x multiple. So I would say the average multiple is probably, if I'm just ballparking it, is probably around like 230x. So then we could apply that multiple to the amount of square feet that my house has. So it would be 230x times 4K square feet. So I'm looking at the multiples that the other houses are trading at, the houses that are similar to mine. And then I do this, and here I think this would equal $920,000. That would be how I would approximate the value of this house by looking at the other houses. But of course, it's important to make sure that these houses are actually comparable to mine. For instance, if mine was right next to a lake, that would mean that it's way more valuable than these other houses. So you need to make sure that they actually are houses that are similar to yours. And then, of course, the other way is we could estimate the present value of the cash flows that the house would give me. So, for instance, the present value of the cash flows would just be the total rental revenue minus all of the costs to having this house to us, right? Property taxes, maintenance and repair, things like that. And we could look at that for however long we're going to own this house, basically into infinity, right? Because that's how long this house could be around. Or maybe the house will only be around for like 100 years. So just figure out how long the house will be around, and then you'll discount all those cash flows back to the present to figure out the value of that asset. So basically, this is how we do actual valuation with real companies. You can either do intrinsic or relative valuation. So these are the two types of valuation. You have intrinsic valuation, which is valuing a financial security or business purely based off of the future cash flows and the riskiness of those cash flows. And the riskiness of those cash flows would determine the discount rate, right? And then there's also the relative valuation, which is valuing a financial security or business based off of how other similar assets are currently trading or have sold for, right? So that is the two types of valuations. And when we think about it, we have to remember, what are we actually valuing? So you could either value the business itself, or you could value the equity of the business. The enterprise value of the business is the value of the business's core operations, while equity value is the value of the business's core operations subtracted by the total amount of debt the business has, plus anything else not related to the business's core operations that give equity holders value. So you might be kind of confused by this. So I'll try to use a house analogy again. Let's say that a house has a actual value just of the house of $1 million. So $1 million house value, so enterprise value. Let's say this house has also has a $500,000 mortgage, so $500,000 worth of debt. And of course, we have to pay off this debt before us as an equity holder have anything left, right? So basically, in that case, if it was just $1 million house and $500,000 worth of debt, our equity would be worth $500,000. So that's what it would be, right? Enterprise value minus debt equals equity value. But you can't forget about the last thing, cash, because that also provides value to equity holders, even though because it provides value to equity holders, but it isn't included in the value of the business. For instance, if for some reason there were just a few bags of cash in that house that were worth $100,000, then as an equity holder, if I'm getting a house that's standalone worth $1 million, and there's also $100K in the house, then and we have $500,000 worth of debt, then instead of it just being enterprise value minus debt, we would also want to add the cash here, because that would be providing my house with value as well. So, and then again, value does not equal price. So when we're thinking about equity value, we can measure that by just looking at the shares outstanding and the share price of a particular business. I could look at the equity value of Apple, of Google, any of these big companies right now by just looking at share price times shares outstanding to get to the market cap, or what we also call equity value. But remember that value does not equal price. When I'm looking at what the market is saying, that is like the market's assessment of value, the price that you can pay to get the stock. And that is not the same as value. Even though it says equity value and enterprise value, no one actually knows the true value of something. You can really only see the price, and it's our job to discern what value actually is. So you can kind of flip this equation around, move it around, and you can get to enterprise value equals equity value plus debt minus cash. So you might be a bit confused because you're like, okay, why are we subtracting cash? Why would having cash make our business less valuable? Well, it actually wouldn't make your business less valuable. What would happen is, if, for instance, you just find $100 worth of cash on the ground, that's not going to make the value of your business go down. What's going to happen is that you're going to have $100 worth of cash, so it is going to make your EV go down by 100 in this equation, but equity value is going to go up by 100 because equity holders derive value from cash, even though cash isn't included in this because it's not related to a business's core operations. It still provides value to equity holders, because if a business just finds cash on the ground, they could hypothetically just pay out a big dividend to their shareholders. So what's going to happen is they will cancel out. This will go up by 100, which is being added, and this will go up by 100, which is being subtracted. So enterprise value as a whole will not change. So that's just something to note. Same thing, that debt does not just inherently make the value of your business more. It is more so that if you raise debt, $100 worth of debt, you'll also get cash, which will cancel each other out. So enterprise value will not actually be affected when you're just like raising debt and getting cash. So I think I did a house example, but I think I already kind of went through that, so I'm going to skip that. I got ahead of myself. Here's just a note on debt versus equity. Debt and equity are the two main ways that a business can raise capital. And inherently, debt is a safer instrument with guaranteed interest payments and priority over equity holders in the event of a bankruptcy scenario. So if basically, like, if you're a homeowner and you go bankrupt, you're not going to get any money until the bank has been paid off first. The bank has priority over you as an equity holder. And because of that, equity is riskier than debt. Equity is a riskier instrument because, one, they're not guaranteed any payments, right? Even if a company pays dividends to their shareholders, they're not guaranteed. The company could cancel those dividends at any time. And also, they have less priority, right? Debt holders have priority over equity holders in a bankruptcy situation. And that kind of gets us to capital structure, right? Stakeholders with lower priority in a company's capital structure will demand a higher rate of return. So you can see this graph here, and it kind of shows the corporate capital structure hierarchy. At the top, you have the safest types of debt instruments, which are secured by the company's assets, which basically means if I give a loan to my friend and he doesn't pay me back, I can seize some sort of collateral that the loan is backed by, some kind of asset. So for instance, if I loan money to a shipping company, the collateral that my loan is secured by could be the ships. So I can rest comfortably knowing that the ship company is going to make sure to pay me back, because if I go seize their collateral, the ships, they won't be able to operate anymore. Versus like unsecured debt, which is not secured by any assets. So because of that, it is less priority than the secured debt. But it's not that risky because they still have priority over subordinated debt or preferred equity or just regular stock, which we call common equity. So debt and equity are not the only types of ways to raise capital, but they are the main types of ways, right? You could have these kind of like hybrid securities as well, like preferred equity, where it's like a combination of debt and equity in one security. So that's just a note. The main thing to remember on this slide is that debt is less risky than equity. And because of that, equity holders are going to demand a higher rate of return. So what are we actually valuing? When we're doing a valuation, we can either value the business itself, the enterprise value, or the equity of the business, which would make sense in the case of like buying stock, right? Because while the value of the business does affect the value of the stock, we care just about what the equity is worth, because then we can compare that to the stock price, which is what we're paying to have the equity of the business. So there's some circumstances where you want to value the enterprise, and then also some where you want to value the equity of the business. But the more important thing here is to always keep things apples to apples. For instance, when we're valuing a business, like I said, the value of any asset is the present value of all the cash flows that you'll get from owning that asset. So when you're valuing a business, you just want to project out the cash flows of the business that are attributable to all investors, both debt and equity holders. So you want to just get all the cash flows that could go to any stakeholder of the business, right? Any of these people in this capital structure, right? You just want to get the cash flows that are attributable to anyone. Whereas if you're valuing the equity of the business, we want to project out the cash flows of the business that are attributable to just the equity holders. So we're going to do the business's cash flows minus what the debt holders get, because we don't care about what the debt holders are going to get, and the debt holders have priority over us. Equity is what we call the residual claimant. They have all of the value after debt holders have been paid off. So when we're valuing equity, we want to get all the cash flows a business will produce minus what the debt holders are going to get, so we can figure out what is only attributable to equity holders. So there's four main valuation methodologies. There's two intrinsic, which the first of which is the discounted cash flow valuation methodology, along with leverage buyout. So both of these are intrinsic, and then the two relative ones, right, when you're looking at other assets and seeing how those trade, are comparable companies analysis and precedent transactions. So I'm going to be going over LBO in the fourth session, the final session. So today I'll just be going over the other three. So the first one is discounted cash flow analysis. So a DCF is a financial model that is an intrinsic valuation. So it's basically valuing a business based off of the future cash flows that a business will generate into perpetuity, which basically means forever. And through valuing all of the cash flows that a business will produce, we can determine the enterprise value of the business. The enterprise value, again, is just like the value of the business's core operations. So we're basically just doing what we were doing with that $10 asset, but at a much larger scale with an actual business. And it's not like that asset where it's just super easy to determine the cash flows of the asset. With an actual business, we have to really think qualitatively about how the business is actually going to do, right? It's like up for debate on how good the business will do. We have to kind of think in our head, okay, how much is revenue going to grow for this business? Do they have any competitors? Are those competitors going to steal any of their customers? Or are they going to steal customers from their other competitors? How are their margins going to look like over the next 10 years? Are they going to be able to reduce their costs in comparison to revenue, or are their costs going to increase? You have to kind of think qualitatively about it and then show those qualitative findings in your quantitative assumptions for how much the business is worth. So there's three main questions that I'm going to be answering today. First is just, how do I define cash flow, right? I've been using the word or term cash flow kind of loosely, right? I haven't really defined it yet. The second one is, what is the discount rate that I use? When we were just looking at the $10 asset, it was very easy because there's only one stakeholder. But in the case of a business, there's a ton of different stakeholders that all incurring different amounts of risks, and as a result, they're all have different return requirements, right? So how do I possibly figure out what discount rate to use? And the last one is, how can I project out the cash flows of a business forever, right? I mean, who am I to say that Apple will have a certain amount of cash flows 100 years from now? Apple, the business, might not even not exist then. So it's really hard to be able to project out the cash flows forever. So I'm going to be talking about that as well. So first, just how do I define cash flow? So for a DCF, we're using unlevered free cash flow. So unlevered means removing the effects of debt. So that's what that means. And then free means cash that we can use to pay investors, debt or equity holders, that won't disrupt the business's operations, right? So I'm not going to assume that a business is just going to cut all of their costs, or they're not going to spend any money on future investments. Because if they were to not spend any money on future investments back into their business or cut all their costs, the business just wouldn't be able to exist for much longer. So free is just like the cash that wouldn't disrupt the business's operations. And the reason why I'm trying to remove the effects of debt is because I'm trying to value the entire business, which is done by projecting out the cash flows attributable to all investors, debt and equity. So because of that, I'm removing the effects of debt. I don't really care about how much debt the business has. I'm just trying to find the value of the business itself. Similar to how how much of a mortgage you have would not affect the value of a house, right? When we look at houses on the street, we don't think, oh, does their house have a mortgage? How is that going to affect the value of the house? Of course, having a mortgage would affect the value of the equity, but as far as the house goes, it's like the left side of the balance sheet. The right side of the balance sheet, the liabilities and shareholders' equity, is more of a function of how the value of the assets changes, right? So we're just focusing on just valuing the business itself, not on debt and equity. So how do I calculate unlevered free cash flow? So the big thing that you'll notice here is I'm doing EBIT times 1 minus the tax rate. So you might be wondering, okay, EBIT is earnings before interest and taxes, and you're just subtracting out taxes, but what about interest? So the reason we're doing this is because interest is attributable to debt holders, but we want to find the value attributable, we want to find the cash flows attributable to all investors. So we don't want to subtract out what's attributable to debt holders, because at the end, we want what's left for debt and equity holders. So because of that, we want to get the cash flows before the debt holders have been paid. So that's why we're not subtracting out interest. So EBIT times 1 minus the tax rate equals NOPAT, which stands for net operating profit after taxes. And then there's three key things we do here to get from NOPAT to unlevered free cash flow. First of all, we subtract, or we add back, depreciation and amortization, because this is a non-cash expense, and we care about how much cash is actually flowing in and out of my business. Then we subtract out CAPEX, right? Because even though we don't normally have this on the income statement, because typically we are capitalizing a business's expenditures. For instance, if a business makes $1,000 CAPEX, and they can use that, let's say they buy a factory for $1,000, and they can use it for 10 years. Instead of showing that on the income statement as $1,000 expense, we'll instead have $100 of depreciation every year. But in reality, when we do CAPEX, it's actually costing us money right now. So we want to show that when we're getting our unlevered free cash flow. And then lastly, we subtract change in operating net working capital. So that is just a change in, we're basically changing operating or current operating assets minus current operating liabilities. We're subtracting the change, because this is net working capital, we're subtracting the change in that. And this is basically correcting between the discrepancy of accrual and cash basis accounting, right? Because sometimes we have things on our income statement that we haven't actually paid for yet. Or sometimes there's things on our income statement that we haven't paid for yet. And we want to actually show how much cash are we actually getting during this period. For instance, if we had $100 of accounts receivable, that means that it shows up as that accounts receivable again is revenue that we've generated, right? Goods or services that we've provided where the customer has not actually paid us in cash yet. So in those circumstances, it's showing up as revenue on our income statement, but we haven't actually gotten cash for that revenue yet. So in that case, that means that our current operating assets, because accounts receivable is a current operating asset, are going to go up. So the change would be 100 here, which makes sense, right? Because we have revenue, but the revenue hasn't been, actually, we haven't gotten cash for it yet. So we want to cancel that out by subtracting out the change in operating net working capital, which in this case would be 100. So we'd be subtracting it negative 100. So that's kind of the rationale for change in operating net working capital. It's kind of just correcting between the discrepancies between accrual and cash basis accounting. So now just like an example of how we could calculate net income versus unlevered free cash flow, because a lot of the line items are the same. So for instance, revenue is 100 in both situations, and you're always going to get to EBIT when you calculate net income or when you calculate unlevered free cash flow. But for net income, you subtract out interest, which in this case is 10% of 200 of debt, right? And then you have 20 of free tax income, and then you have four in taxes, right? 20% of 20, because it's tax rate 20%. So that gets you net income of 16. But for unlevered free cash flow, EBIT is still 40, and you pay 20% of that, so 8 in taxes, and you have 32 in NOPAT, and then you add D&A, subtract CAPEX, subtract net working capital, change in net working capital, and that gets you to 27 in unlevered free cash flow. You might be wondering, Carter, you're actually paying $4 in taxes. That's what's showing up on your income statement. Why are you saying that you're going to have $8 in taxes? Because in reality, your interest will lower your pre-tax income. So when you have interest, you won't have to pay as much in taxes. But here, because I have no interest, aren't I overstating my taxes? Wouldn't that basically be lessening the unlevered free cash flow, even though we paid less taxes, so we should have more in cash attributable to all investors? I'll come back to that later, but just know that for the purposes of the unlevered free cash flow calculation, you are actually overstating how much cash you are actually paying. So it's the same slide. So I explained how you calculate unlevered free cash flow, but now the next important thing is actually discounting the cash flows back to present value. So we do that through the discount rate, which I explained earlier is just the required rate of return for investors based off of the amount of risk that they're incurring. But as you can imagine, it's a bit more complicated. It's a bit more complicated than the example earlier, because there's a lot of different stakeholders here, and they're all incurring a different amount of risk depending on where they are in a business's capital structure. For instance, the equity holders are incurring more risk than the debt holders. So the debt holders might want a 10% return, and then the equity holders would want a 20% return. So how do I possibly figure out the cost of capital or the discount rate in this situation? So what we do is we calculate what is called the weighted average cost of capital. So because of all these different stakeholders, we must find a weighted average of the expected returns of all the different investors across the business's capital structure. So it is basically the cost of raising capital for a business, because it is what they will have to pay out investors. So discount rate is more in terms of as an investor, what is the required rate of return for me? Whereas cost of capital is more like I'm raising capital through debt or equity. How much are my investors going to want to receive as a rate of return? So it's like the cost of getting capital, right? So it's called the weighted average cost of capital because we're weighting the average expected returns or the average required rate of returns of these different stakeholders. And of course, a company's WACC will depend on the riskiness of a business and how its capital structure is structured. So this is where capital structure actually plays a role in the value of a firm because it's affecting WACC. So capital structure does not play a role in the unlevered free cash flow calculation. That calculation is just based off of the business's operations. But of course, the capital structure can affect the value of the business. For instance, Bed Bath & Beyond has like 99% debt because the equity of that company is nearly worthless because they just have so much debt and they're about to go. They actually have already gone into bankruptcy. So in that case, Bed Bath & Beyond has to liquidate. So it's worth a lot less than it would be if they didn't have any debt, right? So debt actually can play a role, or your total capital structure can play a role in how much your business is worth, but it's not going to play a role in unlevered free cash flow. It will play a role in this part of the DCF calculation, the weighted average cost of capital. For instance, Bed Bath & Beyond's weighted average cost of capital would be humongous right now, just because all of these stakeholders are incurring a ridiculous amount of risk. Whereas if they had no debt, then the weighted average cost of capital would not be as high. So this is the formula for weighted average cost of capital. So we weight debt and equity accordingly, depending on how much of a business's capital structure they take up. So this is the formula here. And let's just pretend that these brackets here don't exist, because this picture I got online is actually like wrong. There shouldn't be these brackets here because it messes up the order of operations. Basically, it's weightage of equity times cost of equity plus weightage of debt times cost of debt times 1 plus the tax rate. So, or sorry, 1 minus the tax rate. And the reason why you have 1 minus the tax rate here is because, like I kind of mentioned earlier, the unlevered free cash flow calculation will overstate how much you pay in taxes, because having debt actually provides you with a tax shield because you pay interest, which lowers your taxes. So in the WACC equation, it basically shows this tax shield that having debt has. So, for instance, you might have a cost of debt, the required rate of return for debt holders of 8%. But if you have a 50% tax rate, when you pay those interest payments, it's not actually going to be affecting you as much, because now, because you're paying those interest payments, you don't have to pay as much in taxes. So it really is like a tax shield for you. So it's still costing you money, but not as much money as it would be at face value, because you have to take into account that because you're paying interest, you don't have to pay as much in taxes. So we're trying to find like the true cost of like raising capital for a business, the true cost of capital. So in the cost of capital, we show 1 minus the tax rate. And this is just like a little example of this. You can pause the video, but basically I'm just showing that like debt does actually, in fact, provide a tax shield. So I talked about cost of equity and cost of debt. Cost of equity is just the required rate of return for equity investors based off of the amount of risk that they're incurring. Cost of debt is just the required rate of return for debt investors based off of the amount of risk they're incurring. And remember, equity is almost always riskier than debt because of its priority in capital structure. So cost of equity should almost always be higher than cost of debt. So let's first talk about cost of debt. So again, it's the expected or required rate of return for the average investor of a company's debt. It is essentially a way to measure the riskiness of a company's debt. So presumably, a riskier company like Bed Bath & Beyond would have a higher cost of debt than a less risky company like Apple, for instance. And there's 3 ways to calculate the cost of debt. So the first way is just like the easiest way. This is like the quick and dirty method. You just go to a company's financial statements and you take total interest expense on the income statement divided by the average book value of debt on the company's balance sheet. So the average of the last 2 years, because the average of the last 2 years will determine how much a company paid in interest over the last year. For instance, like if you raise debt like halfway through the year, you would only pay interest. You would have $0 in debt at the beginning, and you have X amount at the end. So that's why you show the average, because that like takes into account how much you're actually paying on average like throughout the year. So that's why you're doing the average of the last 2 years. So that's like the quick and easy way to do it. But this is the way that I recommend the least, because even though it's easy, it's like the least accurate, essentially. Because, for instance, let's say that during COVID, we had basically 0 interest rates, right? That you could get like almost nothing from investing in the risk-free rate, the US government bond. So because of that, companies could charge just a bit high. They could basically pay a bit higher of an interest rate. So for instance, like if the US Treasury bond interest rate is 1%, maybe a company could pay 3% interest to their creditors or their lenders. But of course, once the interest rates across the US go up, so now the US government bonds, you have a 4% interest rate. What do you think happens to those bonds that were previously issued where the company is only paying a 3% interest rate? What's going to happen to the value of those instruments? Well, of course, the value of those instruments is going to go down significantly, because why would anyone want to pay to own a bond where you're getting 3%, where the US government is giving you 4%, right? Because the 3% bond is riskier than the 4% one because the US government is the most risk-free entity there is, right? So you would never pay 3% to have a bond, right, if the US government bond is giving you 4%. So the value of this would go down significantly. But if you're just doing this method, you would still have the total interest expense over the average book value of debt. So this is like an incorrect way to calculate discount rate because it's not always representing the actual opportunity cost there. Because like the interest rates might have changed in the US, so the opportunity cost has changed since you actually raised the debt. You might be able to pay less interest, but the opportunity cost is still changed. So your like true cost of debt would have gone up, even if you're still paying less than interest expense, right? So that means it's not like how much are you paying in interest expense. It's not like the rate of return that someone would get from investing in you. It's the required rate of return that someone would get in investing in you. So that's why it's better to use like average yield to maturity of a company's debt. Yield to maturity is just the IRR of a company's debt. So this is actually factoring in the market value of debt, how much your debt trades at. For instance, if because interest rates have gone up, your debt trades at $80 now, and when it was originally issued at $100, then the yield on that debt, the rate of return is going to go up. Similar to how when you pay $10 for that asset that I presented at the beginning, you'll get a 0% rate of return. But when you pay $6, you're going to get like, a 7% rate of return or something like that, or probably something even higher than that. So when the price goes down, the rate of return goes up. So because you're actually taking into account the price, you're actually showing like what is the opportunity cost at this point in time. And the last way is through credit spreads. So this is basically looking at the rating that these credit agencies rate a company's debt. For instance, if it's really risk-free, it might be AAA, or if it's really risky, it could be like CCC. And like Moody's, S&P, these other rating agencies will go out and basically rate a company's debt based off of how risky it is. So when you're doing this, you can basically see, okay, what do other AAA bonds yield to investors? And on average, it is maybe 1% higher than the risk-free rate, the US government bond. And maybe CCC bonds on average pay 6% higher than the US government rate of return, right? So you can look at how much higher bonds that are rated the same normally pay above the risk-free rate, and then you can basically figure out the cost of debt. For instance, if US Treasury bond is yielding a 1% return right now, and the credit spread is plus 600 basis points. Basis points is just a percentage of a percent, so 0.01%. If it went up 600 basis points, that's plus 6%, right? So in this case, the cost of debt would be 7%. But if U.S. government interest rates go from, if you have U.S. bonds go from 1% to 4%, then that would be 4% plus 600 basis points still. So the cost of debt would have gone from 7% to 10%. Which is good, right? Because when the opportunity cost changes, the cost of debt should go up. So basically, these two methods are preferred over this method because it's not always showing like the actual opportunity cost. Cost of equity is a bit harder because unlike debt, where like the cash flows are actually printed on the bond, right? You know what you're going to be getting in cash flows based off of the amount of interest and like when the company's going to have to pay you back. Equity investors might not actually be getting cash, right? So it's hard than calculating the debt, calculating the cost of debt because the cash flows are not predetermined, right? You do have a claim on all of the residual cash flows, but it's hard to know like what those cash flows will be, right? Because it's the residual amount after the guaranteed ones, which are going to the debt holders. So the most common way to calculate the cost of equity is through the capital asset pricing model, or CAPM. So CAPM is basically this equation. Cost of equity equals risk-free rate plus beta times market return minus risk-free rate. So basically, it's risk-free rate plus beta times what we call the equity risk premium, which is basically the expected return of the entire stock market, the market return, subtracted by the risk-free rate. So this is basically, on average, for the entire market, the amount of return equity holders expect to be compensated for incurring additional risk above the risk of like the risk-free rate, right? So beta is showing a particular stock's volatility in comparison to the entire market, like the S&P 500, right? Like the entire stock market. And it allows us to measure the risk of a particular stock in comparison to the market. So when you're thinking about individual stocks or companies, the cost of equity, like what will change for certain companies is their beta. Beta is basically how we measure the riskiness of one company in comparison to the entire market, based off of like risk that is related to the economy or risks that the entire stock market faces, basically. So this is where we're showing like the individual risk of a company in relation to the overall stock market. So, for instance, if we're just looking at a company that is as risky as the entire stock market, then, and let's say the beta is 1, then it would be like simple, right? For instance, it would just be 4% the risk-free rate plus beta of 1 plus 6%, right? If the market return on average is 10% and the risk-free rate is 4%, this would be 6% times beta of 1 and then plus 4% risk-free rate. And a beta of 1 just means that the stock is comparable in risk to the overall stock market. Whereas if the beta is 2, that means that the stock has way more systematic risk, right? It has way more risk in terms of like if the economy goes up a lot or if the economy goes down a lot, that stock will way overperform and or way underperform. For instance, like a cyclical company like technology, or what's another cyclical thing like casinos, things like that. They're going to have a beta above 1 because they'll do really good when the economy is doing well and really bad when the economy is doing bad. So if a company had a beta of 2, the cost of equity would be higher because equity investors are facing more volatility in these time periods as far as how the stock goes. So in this case, the cost of equity would be higher. A company with a beta of less than 1, which would have a company with beta of less than 1, which would have a lower cost of equity, would be like healthcare, because people need healthcare at all times, right? Even when the economy is doing bad. Same thing with like Walmart, or things that people like actually need, more of needs than wants. So basically, that is how you can calculate the weighted average cost of capital. It's just this formula here. Cost of debt, there's a few ways to do it, right? But in cost of equity, there's a few ways to calculate it. But what it comes down to is you're basically just trying to calculate the required rate of return based off of the amount of risk that they as an investor are facing, the debt holders and the equity holders. So that brings us to our last question. How can I possibly project out the cash flows forever, right? So unfortunately, we cannot feasibly project out a company's future cash flows forever, right? It only makes sense to do it for maybe, 5 to 10 years. I could reasonably, accurately project out the cash flows for 5 years. But once it gets above that, especially over 10 years, it starts to get a little bit dicey. So what we do is we project out the cash flows looking at revenue. We project out revenue, costs, CapEx, net working capital for the first 5 to 10 years. And we actually do a lot of analysis in the company qualitatively and put that into our assumptions. But after that, we calculate a terminal value for the company, which is kind of just the value of the company after the projection period. So basically, for instance, like if we project out the company's cash flows for 10 years, we'll just discount all those cash flows individually back to present value. Whereas our terminal value would be the value of the company after that. So the present value of the cash flows from year 11 to infinity. And then we would discount that terminal value also back to present value. So the value of the company is the present value of the cash flows during the period, and then also all the cash flows after the period. All of that discounted back to present value is the value of a company. So there's 2 main ways to calculate terminal value. The first way is the multiples method, and the second way is the Gordon growth model. So the multiples method is very simple. For instance, if our projected year 10 EBITDA is 1 million, and other similar companies to ours trade at like 10 times EBITDA. So for instance, if like other companies had 100 million in EBITDA, they would on average trade at like $1 billion. Then that means that our terminal value is very simple. We just put 10 times our $1 million in EBITDA, and that gets us to a $10 million terminal value. And EV, it's EV to EBITDA, right? So the multiple in this case, sorry for not writing it out, is EV to EBITDA, enterprise value to EBITDA. Our enterprise value is the present value of the future cash flows. So if we have our enterprise value after year 10, then that is the present value to cash flows from year 11 to infinity. So that's kind of the concept of terminal value. And then the other way is to do this calculation, which the other calculation is like more like combining intrinsic and relative valuation, this is the way to keep it like purely intrinsic. This is the Gordon growth method. Basically, you multiply year 10 unlevered free cash flow times 1 plus growth divided by the discount rate R minus G, with G being growth rate and R being discount rate, right? So very similar to the perpetuity formula, except it factors in growth. And the perpetuity formula is basically cash flow divided by discount rate equals value of perpetuity. For instance, like if I told you that I was going to give you $100 every year from now, you could figure out how much that's worth by just doing 100 divided by the discount rate, because eventually these cash flows will be discounted by so much, like 100 years from now, that they're essentially worth nothing. So this infinite series will converge at this amount. So this formula is very similar to valuing perpetuity, except you also factor in growth, right? So for instance, a company with free cash flow of 1 million, a growth rate of 2%, and a discount rate of 10% would have a terminal value of this. So basically, it's just another method of calculating the terminal value, the value of the company after the projection period, except this method is more intrinsic. Although there's some weaknesses of it, like for instance, most companies will not grow at the same growth rate forever. So that's just like one weakness of it. It's also like really hard to figure out what that growth rate could be, and like changing the growth rate could like have a big change in like your overall valuation from doing a DCF. So that's basically terminal value. It's the present value of all the future cash flows after the period, but it must be discounted back to now. So for instance, if we had a terminal value of 10 million 10 years from now, the present value of this terminal value, assuming this WACC, would be $3.9 million. So this is just an example of what a DCF would end up looking like. If we had a 3-year projection period, which would be a bit on the shorter end, it would look like this. We would first have the cash flow divided by 1 plus WACC to the first power, and then cash flow 2 divided by 1 plus WACC to the second power, right? And then we'd have cash flow 3, 1 plus WACC to the third power. And then we'd have the terminal value, which is basically the value of the company year 3 and on. So we would also discount that by the third power. So it'd be 1 plus WACC to the third power. So this is how we actually do a DCF. It's basically all it comes down to is projecting out the cash flows during the projection period, and then getting the terminal value, so the cash flows after the projection period, and then discounting them all the present value by your weighted average cost of capital. So that's basically the conclusion there. Once we do that, we can arrive at the present value of our unlevered free cash flows, which is our enterprise value. And then from there, we can just use this formula to back into equity value, right? For instance, if we wanted to find the value of the shares themselves of the company, we can just do the enterprise value minus the total amount of debt the company has, plus the total amount of cash that the company has. So although a lot of these concepts are kind of theoretical, like terminal value, unlevered free cash flow, at its core, valuation, it all comes down to just cash flows, risk, and when the cash flows will be, just like that initial example with the $10. So that's kind of it for intrinsic value for today. I'll do LBO in the 4th lecture. So now let's get into relative valuation really quickly. So there's 2 main ways to do relative valuation. So the other 2 valuation methodologies, right? Precedent transactions and comparable companies analysis. Comparable companies analysis is sometimes called comps for short, and it basically just looks at the multiples that companies currently trade at. Precedent transactions, on the other hand, instead of just looking at the multiples that companies currently trade at on the stock market, it looks at the multiples that companies have been sold at, either through private equity or M&A deals. So we already did this process earlier in the lecture when I was talking about houses, right? I figured out the multiples of square feet that these houses traded at, and then I was able to apply those multiples to my house. So we can do the same thing with companies. So first, I just want to talk about what multiples are, right? I use the value to square foot multiple for houses, but there's a lot of multiples that people use for companies. Valuation multiples are shortcuts for valuation that you can use when you're doing relative valuation. And they basically show where a company is trading at in regard to some KPI, key performance indicators. So examples are enterprise value to revenue, enterprise value to EBITDA, P to E, so like market cap to net income, EV to unlevered free cash flow, or price to levered free cash flow, aka market cap to levered free cash flow. For P to E is just share price divided by earnings per share. So if you multiply both of these by shares outstanding, it gets you to market cap or equity value over earnings per share times shares outstanding is just net income earnings. So basically, when you see price to earnings, basically it's the same as market cap to net income. So just like it was for intrinsic value, important to do things on an apples to apples basis. So similar to how when we do a DCF, we're trying to find the value of the whole business. So we use our unlevered free cash flows. The cash flows attributable to everyone. Where when we are trying to find equity value, we need the cash flows only attributable to equity holders. So same thing here. So when we use enterprise value in the numerator, the denominator must be something attributable to all investors. So before debt holders are paid. So like revenue or EBITDA or EBIT or other free cash flow. For market cap, it needs to be something denominator that is something attributable to just equity holders. So after debt holders have been paid. So like net income, for instance, because after that, debt holders have already been paid through interest. So that's a suitable valuation multiple. We need to keep things apples to apples. For instance, it wouldn't make sense to use enterprise value to net income because this is the value of the whole business divided by something that is only attributable to equity investors. So it wouldn't make sense to use a metric like that. You need to do enterprise value over something that is attributable to all investors because this would get messed up by companies that have different capital structures, right? We want to be able to compare companies that have different capital structures. So to do that, we need to do EV divided by something that's attributable to all investors. And same thing with price to earnings ratio. So what do multiples represent? Why would one company trade at a higher multiple than another company? For instance, like let's say one company has net income of $1 billion and market cap of $10 billion. Why would another company have net income of $1 billion? Why would this be? Even though these companies have the same net income, they have different market caps. Well, there's three main reasons, and it really is kind of the crux of intrinsic valuation as a whole. I think company B, the one with a higher multiple, company B would have a higher multiple for three main reasons. First would be it'd be less risky, right? Less risky, that means that the cash flows that company B produces will be more valuable because the required rate of return is lower, similar to how the $10 of that asset is more valuable when it's less risky, right? Second would be more growth. When it's going to grow more, you'd be willing to pay more for these earnings right now. And the last one is higher ROI, right? Because companies are going to invest back into their business, and if you're getting a high return investment, you can also grow your earnings more. So these are the three things that it really comes down to. And it's also just important to note that multiples are just showing what's happening in like the present, right? What net income is right now. For instance, like a company could just have had like a really bad year that isn't indicative of like their future overall. So that's kind of the danger of using multiples is they really are a shortcut because like valuation comes down to like the value of all the cash flows into perpetuity, discounted back to present value, not just like 1 year, which is kind of what a multiple is showing, right? So basically, what do multiples represent? Yeah, I basically already talked about it. For instance, like technology stocks would trade at higher multiples, while paper stocks would trade at lower multiples. Because technology stocks have much higher ROI, right? Because they don't have to invest much back in their businesses, and they're growing a lot more. Where paper stocks have less growth and less ROI because they have to invest a lot into these like paper machines, and then even then they don't even end up being that profitable. So low multiples for like paper stocks. And lastly, what's the difference between comps and precedent transactions? So the process is the exact same for both, really. You're just taking the average or median multiple of other companies that are similar to your company, and then you're looking at it and applying the multiple to your company's KPI. So it's the same process as we did earlier for the house. For instance, if my company is $1 billion of EBIT, and other comparable companies trade at 12 times, 10 times, and 6 times EV to EBIT, then the average multiple would be 9x. So I could just put that 9x multiple on my company, and the enterprise value would be $9 billion, my estimate of value from this relative valuation. And the main difference between precedent transactions is just that these are deals that have actually gone through, whereas comps show the price of the business is like actually trading out on the market right now. So someone might prefer precedent transactions because, like, for instance, if you're looking to create an M&A deal or go through with an M&A deal, you might think that the market is being irrational and that like other like actual informed buyers, like other companies, would not actually be willing to pay that much. So you want to look at like other deals that have actually gone through by other companies or private equity firms. But you might also want to look at comps too, because maybe there haven't been any recent deals. So it makes more sense to look at comps. But at its core, valuation all really just comes down to trying to figure out what something is worth. You can do it through intrinsic valuation, which is trying to find the present value of future cash flows attributable to you as an investor, or relative valuation, which is looking at other similar assets and valuing your asset through that. But yeah, that's all for this review video. Thanks, y'all.